So, hello once again, Business English 3 students. We are actually getting towards the end of the semester, so we only have 2 weeks of material left. At this point, we've been investors and made money, or let's say maximized our money and increased it. And we've gone over ethics and some of the situations that investing brings about with various government entities and private entities. Then last week we turned back to the personal, and it was about, we mentioned how or sometimes in order to make money you got to spend money or borrow money, and so it was loans. So now that we have all this money, sometimes it's about protecting that money, and that's really where insurance comes in. And the last 2 units we're actually going to cover are insurance and accounting. So accounting is keeping track of your money, and insurance is protecting your money. We're going to do accounting next week. So this week it's insurance. And we'll begin with a definition of insurance. So in your lovely books, I'm actually going to read the first sentence off. And this is the definition of insurance. And there are some interesting words here, so we're going to talk about them. In Unit 24 on page 194, it says, insurance is the provision which a prudent man makes against fortuitous or inevitable contingencies, loss, or misfortune. And that's the definition. They go on to say it is a form of spreading risk. So really you're looking for protection. But insurance gives you one kind of protection, and that's financial protection. So let's take a look at a few of these words here. They mention provision, prudent, fortuitous, inevitable, and contingencies. So those are a lot of pretty difficult words, and I'd like to talk about them before we go any further. So provision, of course, comes from the same root as provide. And here it says insurance is the provision which a prudent man makes. So, of course, or woman, or company, or other entity. So a provision is of course, providing of something. And with insurance, it's the provision of money. You have financial protection. So if you're a prudent man or woman or institution, that means you are appropriately cautious. So that's what prudent means, essentially. It's a more positive spin on being cautious. So then you have fortuitous or inevitable contingencies, loss, or misfortune. These are all kind of similar words rolled together. When we think fortuitous, we often think of, something good happening. But fortuitous in its essence is related to fate. So fortune can be bad or good. So here, fortuitous is basically the unexpected or the things that fate may bring. And then inevitable contingencies are more or less the same things. Contingencies are things that happen based on other events. You often hear something like a contingency plan, and that is a plan for... it's a plan made based on something happening. So like, if this happens, then this, and then you've got a contingency plan. But many contingencies are both, depending on how you look at it, inevitable or unpredictable. So you don't know what's coming, and that's why you get insurance. So if something bad happens, you get some kind of protection, and that protection is monetary, right? It's only financial protection. Insurance won't save you from anything else. So, the book primarily focuses on commercial insurance. So we're going to go well beyond that because we're going to take a look at it from the approach of an individual, just like we did with investing, and just like we did with loans. So if we look at the book and the way it covers it, really the only things you get presented are marine insurance. That's it. So that's not the only kind of insurance that's out there for us. So we're going to talk about some of the other insurances out there, the other types of insurance, I should say, and what components and terms are necessary for insurance to be created. So in the book, like I said, it largely focuses on marine insurance. And although it says marine insurance, it's really transport insurance. So if you're a distributor, it's a focus, or a transporter or an importer or an exporter or a producer or a buyer. You want to protect your stuff on the way, wherever it's going. And you protect it with insurance. So if something happens, you get reimbursed or you get paid for that loss. So they mentioned the perils of land, sea, and air, and there are a lot. There are a lot of perils that can lead to either loss or damaged goods. So when it comes to perils or the dangers or the risks of the sea, land, and air, there's theft, there's piracy, that could be human risk that's introduced, mishandling, and those are all human. And then there's collision, which could be human and circumstantial. Then you have the perils of natural events, natural disasters, all kinds of natural disasters, hurricanes, floods, everything. There's mechanical failure, which is kind of neither natural nor man, it just happens. There is stranding, there is sinking. So you have many of these risks at play, and that's why you want insurance. As individuals, we also want to protect ourselves. So when we think about what we're looking to protect, then there are major insurances or types of insurance that are common in our marketplace for individuals as well as for, let's say, legal entities. So some of the most common ones are, and you may have heard of these before, I'm sure you've heard of them before, are life insurance, travel insurance, health or medical insurance, home insurance, property insurance, car insurance, transport insurance, like we talked about, personal payment insurance, which is something that's often necessary in taking a loan, for example, and then various types of natural disaster insurance, which can be overlap with property or home insurance. So essentially what we need to talk about briefly is, regardless of what kind of insurance you want to get, each type will have certain components that need to be defined in order for that insurance to be created. So let's talk about that a little bit. The components of insurance. So generally, of course, you have, let's start with this. Policy is the name of an insurance contract. So that if you hear policy, we say insurance policy, that's the contract made between the insurer and the insured. Now, those are not the only parties that are privy to an insurance contract. So when we think about insurance, we also have to think about who is part of that agreement. So let's talk about that as well. Now, sometimes there is just one, or let's say two parties. Sometimes there could be more than that. But let's name them. Okay, so when we think about the parties involved, we mentioned two of them. There's the insured and the insurer. Then there is the underwriter. Now, the underwriter is the one that's often the insurer, and that's the one who is legally responsible for paying for the insurance. So generally, the underwriter and the insurer are the same party. Then you have the beneficiary. That is the one who benefits from the insurance, who receives payment for the insurance. And then you have the payer, of course, who is paying for the insurance. So those are the essential parties, and they're also part of the terms or components that make up the insurance. So let's get to that next, and then we'll talk about how some of these could be active in these types of insurance. So essentially, you have purpose. Now, purpose is probably the most detailed element here in the insurance. So, and it's made up of a couple similar categories. So when we think about the purpose, this often is defined by the type of insurance that you choose, but not always. So the purpose is who or what is covered and what risks are covered. Now, let's bring up an example here. Let's say you have home insurance, then that's what is covered, right? But what is it protected from, right? So the more risks you protect your home from, generally, the more expensive your insurance is going to be. Sometimes you have insurances that are based only on one type of risk. So you might get home insurance or property insurance and protect it from certain risks, like, let's say, fire. But what may not be built into the contract is, let's say, flooding, or earthquakes, or hurricanes, depending on where you live. So sometimes you have an additional insurance or a separate insurance named for the natural disaster, like flood insurance, or hurricane insurance, or earthquake insurance. And that may not be built into the property contract. You have to get that in addition. So that depends on where you are. Like, my brother lives in San Francisco. Buildings there need earthquake insurance. My parents live in Florida. They need hurricane insurance. And we live in Serbia. And you remember a few years back, there was massive flooding along the Sava River. And if you're along the Danube or in the floodplain of a major river, like in America, that could be the Mississippi, but here it's the Danube or the Sava, then you want flood insurance. So that'll protect you financially from loss by flood. So the purpose is what is covered and what is that element protected from. And we'll get into a little more detail about that with some other insurances or types of insurance. So then we have to decide on the time period or the duration of insurance. Is it, a one-time period? Like, for example, a travel insurance, which might just be a few weeks and it's just one time. Or is it a cyclical insurance? Is it something that is, let's say, renewed each year? Rotating insurance, for example. So there are many different times that you can have when it comes to insurance. Then, of course, there's the payment plan, basically. So the amounts. But the amounts, there are different amounts that we have to be aware of. So the main two are the premiums. That's what it's called. A premium is the amount that we, the payer, pay. That's just what it's called. You pay a premium. That's your financial obligation to get the insurance. Then what you have is the principal, and that is the agreed upon sum or amount that insurance can pay back to you. And often, if something happens, then you submit a claim. So those are called claims payments, and they're linked to the principal. So we're going to get into a few examples of the types of insurance that are out there. But essentially, let's say you want to protect your home for a year, so you pay 100 euros. That's the premium you pay. Then the principal, let's say, is 10,000. Then for that year, you are covered up to 10,000 euros of loss. So if something happens, you submit a claim. Let's say you have, a tree falls on your house, and that's in the contract. Then you need roof work, rain damage on the walls, and some structural damage to the house. So you submit that claim, and if approved, you get payment, but you cannot get more than the principal. You can only get up to 10,000. Anything above that, and you have to pay for it yourself. So, of course, the larger the principal, or the larger amount that you want as protection, the more you're going to have to pay. So one thing that can also be determined when it comes to amounts and timing is if it's an insurance that has installments, then like with loans, when do you pay and how much, and when are they scheduled? So how many payments are there, and when are they scheduled, and how much is each individual payment? So the policy, like I said, covers all of this and stands as the entire contract. For shipping insurance, as it's mentioned in the book, you might have a certificate that covers each individual shipment within a larger period. So let's talk about some examples of how these components can work for some of the major types of insurance. So one of the most recognized is life insurance. In your book, this is defined as assurance, but life insurance and assurance are really the same thing. This is a unique model of insurance, or as we say, assurance, because the beneficiary is not the insurer or the payer. When we get life insurance, or let's say often not often the beneficiary is not the insurer or the payer, but rather a separate beneficiary. Because generally, the traditional model of life insurance is someone else gets paid in case you die. That's it, right? It's not going to save your life, and you don't need money when you're dead, whether there's an afterlife or not. So here, when we think about the parties represented, you are the insured. The what is covered is you, and the risk is death. So if death happens to you, then the insurer, who you've agreed with according to contract, will pay a named beneficiary, which is often family or friends. So let's say you have a life insurance policy. The traditional model would say you put down maybe one sum right at the beginning, or you pay annually. Let's say 10,000. Let's say you pay 1,000 euros once, or 100 euros each year. The older you are, and the more risky a category you are, then the more you're going to pay. So, and then at some point, most insurance companies will just stop offering it, because if you're too old or you're too risky an investment, then they're not going to cover you. So this happens with other types of insurance as well. So essentially, the life insurance model is you pay, you're the insurer. I'm sorry, you're the insurer or the payer, and then you're the insured or the payer. So you pay either once or you pay regularly. Then the insurer is there to pay if death happens in a certain period. And then if that happens, there's an agreed upon sum, and that sum will go to a beneficiary. And traditionally, the model is if you die, that insurance company will pay this person who's the beneficiary. These days, there's a lot of hybrid models. So you have insurance that you'll pay. I mean, I know people who have this. You pay annually, say 300 or 400 euros, and then for the next 20 years, you're covered against. And here it's a combination often of life and, let's say, disability insurance. So if you're incapacitated or have an injury that prevents you from working, or then you can be the beneficiary during that 20-year period. If you die during that period, then someone else gets that money. So there are, let's say, other versions out there of life insurance which protect you. And in that way, you have these hybrid insurances, which are like life insurance, workers' compensation insurance or disability insurance, and health insurance or emergency health insurance in this typical model. Now, one that I think most of you have, the most likely insurance that you have experience with is travel insurance. Now, travel insurance, again, you are the insured thing most of the time. You're the foundation of that policy. So who or what is covered is you. Then risks covered, well, there are a lot out there. And then the duration of time is important. And the amount of the principal is also important. So the larger the principal, let's say, if you're going abroad, then you have to decide. I mean, first, who are you? That has to be defined, and that's very important for life insurance or for travel insurance because you are going to be the one protected financially. So, where you're going and how risky it is can affect how costly the insurance will be. Who you are and how risky your, let's say, your bracket of the population is can also affect the price of the insurance at the end. So essentially what you need to define is, you'll also be the beneficiary. So travel insurance can be pretty complicated, even though it's the most commonly used in I would say most people's lives because we all often travel every year. So what you have to define is who are you, where are you going, how long are you going there, what do you want to be protected from, and do you want to protect other things besides you, like luggage or travel delays or travel cancellations or accommodation cancellations. So for every who or what is covered that is added onto you, the higher the price of the insurance will be, or the higher the premium will be. For every day that your journey is longer, the price will go up. For every country or place that you add, the price will go up. Depending on the places and their level of risk, the price can go up. Like if you're going to Africa, it's going to cost you more than if you're going to Greece, right? So all of those are going to push up the premium you have to pay, and then the amount that you want to be protected is also going to push up the price. So if you want to be protected up to 10,000, there'll be one price. If you want to be protected up to 20,000, there's another price. If you want to be protected up to 30,000 euros, that's going to be another price. So all of these affect the premium or the amount that you're going to pay. So this is true for almost every insurance. Let's take one more example. Two more examples. So if it's car insurance, for example, then the newer the car, the pricier the car, and the more sporty the model, or risky the model, the more you're going to pay. So if you get auto insurance, then if you have an older car, you're going to pay less. And if you have a newer, fancier car, you're going to pay more, right? And then the more you want protection, like the level of protection you want, 5,000 euros, 10,000 euros, 50,000 euros, 20,000 euros, the more you're going to pay. The duration is also going to affect that. Generally, it's on a 1-year rotating contract. Here in Serbia, we have to get car insurance every year, and that's generally how it's done in America. And then you pay once up front. It's one payment, and you're covered for a year. Now, another choice that you have to make here is what is covered. Traditionally, the cheapest option for car insurance is that if there's an accident, your car is covered up to, let's say, 5,000 euros. And that's that. But most auto insurances also include other considerations. So for every element that's covered, the price is going to go up. So if your car is covered and that's it, it's going to be cheaper. If your car is covered plus the other car, in case there's a collision, is covered, then the price is going to go up. If your health is also included this, if you get injuries based on the accident, then that's going to add on to that. So the more complex the insurance, then, and the more elements that are covered, the higher the price is going to be. Also, what are you protected from? Well, this is also going to increase the price. If you're protected from just from your own mistakes, like crashing into a tree, that's going to be one price. If you want protection from other risks, like, people crashing into your car in the parking lot, a tree falling on your car, flooding happening, each one of those is going to be an increase to the cost of insurance. So, one example, like my aunt had a car, this is like 20 years ago, and she had insurance, and it covered quite a few things like theft, broken windows, damage, collision, her own collision with other cars, but she didn't have flood insurance. And her car got flooded. The river overflowed its banks and ruined her car. But since she was not protected from flooding, that even though she had paid her premiums regularly, she got nothing, right? It wasn't in the contract. So this is also true for home insurance. If your home insurance has certain risks covered and then those happen, then you get paid. But if, let's say, your home insurance lacks flood insurance and then there's a flood, even though your home is damaged, if you don't have flood built into the contract, then you don't get paid. So that's essentially what insurance is there to do. It's to protect your valuable assets or yourself from unexpected bad things, right? Or inevitable contingencies, misfortune. So your homework is going to be to get a type of insurance. So you are going to pick either yourself or something else, like a piece of property or auto insurance or some travel insurance if you have a trip that you're planning. Okay, these days with coronavirus, that's very difficult to plan because we may not be allowed to do it, but this is theoretical anyway. So you are going to get a policy. And in your policy, you have to describe all of these elements. So I'm also posting notes about these insurance elements so you can refer to them. But what you have to define is who are the parties involved, and you have to describe those parties. So who or what is covered. If that's you, you have to provide a description of yourself. What do you want protection from? So you have to define the risks. You have to define the length of the insurance, and then you have to define how much you want to be covered, like up to what number, and of course, based on those things, how much you're going to pay. So all of those things will determine how much you pay, and that's kind of the last number. And you should go to a website for an insurance provider to get this, and you can get what we call a quote. So whether it's auto insurance or life insurance, maybe you already have insurance, and then you can use that as the assignment. But whether it's auto insurance, home insurance, or property insurance, life insurance, medical insurance, travel insurance, you should make a policy using a website or an existent insurance company to cover all those elements. And then they'll generally have a calculator where you can create a quote, and then you'll know how much you're going to pay. So that's your assignment. Now, I will, of course, post that in the notes as well, in detail, exactly what I want you to do, but that's essentially what it is. Your assignment is to choose an insurance policy and describe it and define it according to the terms that we discussed just now. So the insurance components and terms, purpose, time, amounts of payment, the parties involved, when payments are going to happen, and of course, all of the detailed elements that go into that. So Now brace yourselves for a moment and take a deep breath, because, are you ready? This is the last task journal assignment you'll ever have to do. I know, it's sad, but it's true. Next week we'll be doing accounting, and there will be no task journal assignment. So, it's the end of your long relationship with task journals. Wipe the tears away. And don't let them get in the way of your doing the assignment. So this assignment will be due next week, and then that'll be our last week of material. So I'll also be posting a message about the nature of our colloquiums in the coming weeks. If you have any questions, of course, regarding the insurance assignment once I post the notes, then please correspond with me. In the meantime, good luck, stay safe, enjoy your potentially imprisoned May 1st holiday weekend, and I look forward to seeing what types of insurance you choose and what kind of terms you come up with. So that's it. Goodbye.